think it must be a bittersweet moment for you because this is your last set of earnings as CEO. So first of all, let me just start off by asking you, how are you feeling?
Thank you, Jemana. I'm feeling really good. I think we've delivered a very strong set of results in the first 6 months of this year, following a record profit year last year. So really pleased that we've delivered a return on tangible equity of 17%, excluding notable items. So listen, I'm pleased not only for our shareholders, but also for the 200,000 colleagues around the world who have made this possible to deliver a financial performance this strong. I'm pleased at the way that they've handled the past 5 years, the work they've done, the transformation, and the results today are testament to the work that they've put in, and match the heritage of HSBC and the strategic promise of HSBC. The financial results now match that. And that's why I'm also very pleased today that we've announced a $3 billion buyback program, having completed $3 billion over the last 3 months. And just, Jemana, just one thing that sometimes we tend to forget is quarter by quarter, but in the last 18 months, we've distributed to our shareholders $34 billion of capital, either via dividends or buybacks, and that's in 18 months, and $54 billion over the past 5 years.
So let's talk more about the earnings, and specifically that share buyback number, $3 billion, higher than what the market was anticipating. How do you square up the market's expectations of what you can offer in terms of share buybacks versus, say, the need to continue investing in the business or in other areas, or M&A, for example?
Well, we said this year and last year as well that we would operate a 50% dividend payout ratio. So 50% goes in dividends, 50% is retained in the bank, and that it can be retained either to fund growth and/or additional buybacks, additional distribution to shareholders in the way of buybacks. That second 50% can do both and is doing both. We're retaining sufficient to drive growth, and we're distributing any excess because we've still got a very strong capital ratio, CET1 ratio. We're quite well above our target range. Therefore, we're able to both grow and distribute via buybacks. We do not pre-announce buybacks. We do it on a quarter-by-quarter basis. But I'm pleased that we've announced $3 billion today, and it's a function of the high returns that we're generating and the good profit performance we're generating and our confidence for the future. The other thing we announced today is a new target, a new guidance of mid-teens returns for 2025. That's a new piece of information we've put into the market. That is evidence of our confidence of our ability to continue to deliver good, strong financial performance. Even if interest rates come down, we built alternative revenue growth strategies to provide us with the sustainability of returns going forward as interest rates come down.
Yeah, let me ask you about that, because I see that you now expect banking NII of around $43 billion for 2024. I believe that number before was $41 billion. So a slight upgrade coming through there. Some would say it's surprising because HSBC is one of the banks that is more sensitive to a lower interest rate environment. So why did the upgrade come through?
2 reasons. Firstly, well, probably 3 reasons. One, the yield curve has shifted to the right a little bit. The declines are taking place slower than originally. But the most important factor, if you go back to around about 2022, our sensitivity to interest rate declines back then for a 1% decline was around about just over $7 billion. We reported at the end of last year that $7 billion had come down for a 1% decline to around about $3.3, $3.4 billion. We reported at this half year that a 1% decline has now come down further to around about $2.6 billion. So we have consciously put in structural hedging that lessens our sensitivity to interest rates. But as importantly, we've also grown and invested in alternative revenue streams and business activities to drive revenue growth from non-interest dependent sources, fee income, wealth management, transaction banking, internationalization of our client base. And as you saw in the first half, our revenue from wealth management was up 12% year on year. a very good second quarter performance following a very good Q1 performance. We're seeing resilience in our transaction banking fee income. Fee income, I think, grew by around about 4%. So what we're doing is we've lessened the interest rate sensitivity, and we've invested in alternative business lines to grow revenue from other sources. And that's what's given us the confidence to announce a mid-teens return target for 2025 and have confirmed our target for 2024.
So management of costs is a consistent theme, and I know it has been a focus of yours during your tenure. Back in 2020, you said that HSBC would look to scale back its headcount from 235,000 to around 200,000. But if we look at the headcount for 2023, it was 220,000. Do you see scope for further headcount reduction or redeployment of personnel as one avenue to keep costs under control?
I mean, the most important thing we've said today is we are reconfirming our full-year target cost growth of 5%. We're absolutely committed to that. We will not deviate from that, and we're on track to deliver that at the half year. So that is the most important thing. We're very much focused on cost management, and we do not have, per se, an FTE target or a headcount target. We have cost target. I'm also pleased that at the end of last year, we had a cost efficiency ratio of 48.5%, which was well down from when I took over 5 years ago. That cost efficiency ratio was more in the 60 to 65% range. So we've had good performance on cost. What we're also doing is investing in the business, and we're investing in areas that are important for revenue growth, revenue resilience, and return resilience. And you see the evidence of that in the first 6 months' performance.
Yeah. I do want to ask you about some of the economic signals that are coming out of China. It is a big macroeconomic theme, and I think you have unique insights into what's going on there. So how do you see economic activity on the ground, and what can you tell us about the commercial real estate portfolio?
Well, we took minimal provisions on the commercial real estate portfolio in the first 6 months of this year. We took a significant amount of provisions last year and a bit the year before. We've seen that market stabilize. I think it's still got quite a bit of recovery and time to go through on its recovery journey, but I think the worst is behind us. We think we're well provisioned for that portfolio. And that's the situation that we've experienced in the first 6 months. More broadly, in the mainland Chinese economy, I think we remain confident about the medium and long-term prospects for the Chinese economy. There are parts of the economy that are performing extremely strongly. Anything in the higher value-added manufacturing sector, innovation sector, anything to do with green energy, climate, there's strong activity taking place there. I think, the commercial real estate sector is challenged, but we believe that actually we've seen the worst of that. We're in a slow recovery from there. So I'd say it's mixed, depending on which part of the economy you're talking about. But again, I've said this many times, China has had an economic growth model that has served it really well over the past 3 to 4 decades. That economic growth model is now changing, and it's right that economic growth model is changing. Yeah. And the administration in China have moved to an alternative growth model that's less dependent on infrastructure spend, less dependent on purely low value-added manufacturing exports, moving more up the value chain, diversifying its export markets. So I think we're going through a transition phase. How long will that transition phase take is to be determined. But am I confident that there is growth opportunities in China? Yes, we're still an investor in China. And I do think that their target of around 5% GDP growth is still achievable this year. But there are some bumps on the road as you go through that journey.
Yeah. Well, Noel, when you announced that you were retiring from HSBC, you said that the bank was sitting at an inflection point. And if you look back at your tenure, it would be exemplified by the pivot to Asia strategy, a lot of the streamlining of the business. What's in store for HSBC in the future? Why did you say it was at an inflection point?
Well, I think we've done a huge amount of transformation over the past 5 years. We've rationalized the portfolio significantly, both organically and inorganically. You know, we ran down around about $128 billion of risk-weighted assets over the past 5 years on business lines, customer segments that were not profitable or not strategic. That was a huge transformation exercise. We also exited a lot of businesses via sales, M&A activity, the French retail business, the retail business in the US, Canada, Russia, Argentina is underway. A lot of M&A activity on the disposal side, and we've also purchased. So that transformation agenda has delivered a significant amount of change, and you're now seeing the benefits of that in today's financial performance. The real transition point now is, having done the bulk of the transformation, is continue to drive sustainable returns and revenue growth off a much more stable base and a business model that is much more focused, and I would say it's focused around internationalism. We're a connector to the world, of the world. And what we do is connecting economies to each other and connecting businesses to opportunities around the world. We're an international bank that have a unique presence in banking the entrepreneurs of the world and helping them navigate what is a complex world. And that's what we've done for 158 years. And that is a source of future revenue growth. The world will change, but we've been changing with it over the last 158 years.
Well, before I let you go, I also want to ask about your successor, Georges Elhedery, Lebanese-born, French-educated. What does it tell us about the direction of the bank that the incoming CEO is the first time a non-British person is going to be leading the bank?
Well, listen, I'm really pleased for George. The only advice I've ever given him is enjoy the job. It's an absolute privilege performing this role. We understand the importance we play, the importance of we are to our shareholders and to our colleagues, and he will do an excellent job. I wish him all the best for the future and the success that he deserves and the bank deserves. But the most important thing is enjoy the job. It's an absolute privilege. I've enjoyed it. Despite the challenges, despite the workload and the travel, it's been an absolute privilege. And look, I've had 37 years of banking career with HSBC Group. I would never have imagined being in this position. I know how he now feels as he's about to take over, and he'll enjoy it immensely. He's supremely well equipped to do this job.